Okay, good evening, ladies and gentlemen, Clueless 8 Advanced Coaching Session members. This is Frank, Clueless 8, and this is tonight's October 25th, 2015's Advanced Sunday Night Coaching Sessions, getting ready for next week. Um, we have Vix, we have Shawnee Shelley, we have Jeremy Pester, Paris, we have Mark Bader, we have Guru, Jason Pierce, we have Vix, we have Julian, um, we have Rimick. That's our newest addition to our club. And am I missing anyone that can? I don't think so. One second. Great. So that's good. Okay. So here we have a very international crowd. And Julian, thanks for participating. I know it's kind of off time, but Madrid Madrid wakes up at 10 at night, so so you're
Yeah,
actually you're on good time, man. Love
yeah, yeah.
love the city. Been there a while ago, and wish I had more time in between family life and what we do to get out there, but we certainly will. Um, okay, so we're going to break this segment down. Tonight's session kicking off here at around 8:15 p.m., 8:17 p.m. right now. We are going to, first of all, we're going to talk a little bit about the macroeconomic part because it is extremely critical that all Clueless 8 members and traders have a basic understanding of why things are happening. What is happening right now is not happening because of some magic happenstance, as they like to say. This is not Alice in Wonderland. This is in reality what's happening in the macro global arena, and at certain times markets latch into hi, who joined us?
Jack.
Who is this?
Jack.
Jack who?
Jack you. Jack IU is my handle.
Yes, bear with me 1 second. Sorry about that, guys. Hold on. Yes, sir. Is it you or Lou?
You.
Y IU, correct?
It's supposed to be yeah, IU.
Okay, very good. Okay, we have Jack Yu joining us. Welcome. So and by the way, okay, no problem. All right. So what happens is just because, as you know, my service, my advanced coaching sessions, which are critical in my opinion, because not only does it help all my members, it puts me in focus into what is relevant and what is critical at a time. The simplest secret, in my opinion, of what Wall Street does, what it does, and I've been on Wall Street for many years. I watched, observed, and learned is that at any given time, they'll latch into one or two what they consider to be, and when I say they, I mean the more powerful investment banks, what they consider to be an important economic or market related function. In other words, there could be 10, 15 different things going on, but they will give importance, they prioritize in those early morning meetings up at the Goldman Sachs headquarters, okay, on Broad Street. So it's like up there in those higher echelons of where decisions are made, and the analysts are briefed on what's going on, and the market strategists come on in the early morning meetings. They will prioritize what they are looking at and what is important, even though it might not be the most important thing, but it doesn't matter. They find that, okay, for this week, for the following 2 weeks, this is what we consider to be important. So this is what the media is going to talk about, and this is what we are going to keep on talking about. So therein lies one of the biggest value added services of being with the Clueless 8 trading service, because I understand the mentality. I have been in those type of meetings, and I see what they are doing. So even after all these years, and it hasn't been that long, it's been about 5 years since I left Wall Street, it's still fresh in my head as to what they consider to be important at that time. That's something that it doesn't matter how good a trader you are on the outside, you will not understand. The mentality and the behavioral aspect of how institutional big money thinks. So that's number one. So that's one of the reasons why we're going to talk a little bit about the macroeconomic factors about what's driving the market, i.e., the global finance stuff, and could be brief. And the second thing we're going to talk about is a little bit about the money management stuff, not your and my money management. I'm talking about the money management in the form of the mutual fund and the 800-pound gorilla in the market, which is the multi hundreds of trillions of dollars or $100 trillion. I don't know the number actually in my top of my head, but it's a very large number that manages the global money and specifically out of the US and what their dynamics are in this month of October and as we move towards the end of the year. I have talked about it many times before, but I'm still going to focus on that. The third thing we're going to talk about is we're going to basically, I'm going to try to explain, is the behavioral aspect of what you're seeing behind you. Why is that when we look back, it's like this beautiful scenario, like, oh, wow, it's coming back to where it started to crash from. And in that same vein, in the same connection, I will basically attempt to explain, and many of you know and you understand that I've done that before, as to why, if you were relying on the media, if you're relying on the pundits on StockTwits and other forums that are out there, that did they ever tell you we would be here? Or were they all crying about the death cross and the side cross and God knows what cross, motor cross, just kidding, and that we are finished and that the US economy is done and that the global economy is going to go into free fall. We're going into a massive recession and a depression. That's all you heard. And guess what? It's not the first time you heard that. And you heard that from the big shot traders who post. You hear that from what you read. You hear that from the pundits who come on TV. How many analysts came on TV during these brutal crashes? And these are brutal, okay? Dual brutality, if you want to look at it that way, and said, listen, these look like very solid fundamental points where we can basically aggressively attack the market. Never, ever have you heard that. And I'm not saying that somebody should come in at these inflective bottoms. Okay, these are very pivotal bottoms and tell everybody to put all their monies in the market. I'm not saying that. I didn't even say that. But I simply projected a powerful scenario. Keep in mind that I am cautious with a bullish bias. I am still cautious with a bullish bias. That means that get ready to attack the market, because if these things, which we're going to walk through on the technical side tonight, happen, then watch out. Whatever major shorts that are out there are going to basically be decimated. That is exactly what happened, and that is exactly what's happening. It does not mean, I want everyone to be very careful about this. It does not mean that we are entering the next phase of the bull market. It does not mean that. It simply means that the markets still have room to climb higher, and then we see what happens after that. And it doesn't also mean that all of a sudden we're going to lose it all, revisit the lows, and enter some deep dark tunnel, okay, that we can't get out of. Because the further you move away from these levels here on the markets, the more difficult it is for the market to get there. It's called momentum. You're expecting another 2,000, 3,000 point drop? Sure can happen, but don't expect it that fast, because if I knew that was coming, I would be short 1,000 S&P puts and make $10 million over 2 weeks. Seriously, okay? It's never that easy. Obviously, we know that, both on the upside and the downside. So the gurus, I like to warn everyone, because I'm sure you look at other forums and stuff, and you should. I'm just one voice in the wilderness. Maybe a very contrarian voice, maybe a very different way of thinking at things. That's fine. That's just me. As long as I don't get too weird, it's okay. So the point is, that was a joke, by the way. So the point is that that listen to all other different ideas. then use mine as also another idea to work off things. I mean, to employ in your arsenal, your tool. This is the same chart as this. It's almost like the iPhone thing, right? You change the background colors, but this is it does show you, you know, a little bit more. So think about some of these things that I said. Now let's talk about the macroeconomic factors, what's going on. Okay, look, the market is a very manipulated animal. Don't fool yourself. People come into the service, you know, some of my friends too, and they're like, oh my God, how can that stock go up? I mean, that's like crazy, the PE and all that stuff. Let me warn you guys, do not attempt to be some sort of closet analyst, because the point is, nope, even the top analysts are dead wrong. Did the top analysts come to you and said, buy the crap out of Amazon and Google and all these companies, and we basically nailed them big time? Did they come and tell you short CMG? We made 60 points on it on the downside? No, they don't. Okay, not that, you know, because not that they don't know. Maybe some of them actually totally are, you know, ignorant. I don't know. They're great analysts, but when you look at the face of it. So the bottom line is that don't attempt to analyze things too much, please. Because if you knew what the exact fundamentals are, you honestly believe. If anybody who's a trader or anybody who's listening here tonight, if you believe that Wall Street runs on fundamentals, then you don't understand life. Life happens. What's the term? Life happens in between our grand plans. Well, the same thing with Wall Street. Because it's called animal spirits. It's called animal spirits, okay? And bear with me one second. Bear with me. Somebody just PM me from. I'm sorry. Oh, Venkat. Okay. Okay. It's called animal spirit. It is basically when this sense of risk comes into the market. Okay. That's why the market is called risk on and risk off. And let me just say something very clearly. What you witnessed over the last 6 months, let's say, or as recently as August, forget about last 6 months, as recently as August, everyone can see the screen, correct?
Yes.
Because it's very important. Visual is very, very important. Very important. So what you have witnessed since the end of August, what I have witnessed since the end of August, so obviously I've witnessed more things in the market, having been in the industry for a while. This was so everything that has happened since the end of August, please, I highly, strongly recommend that you learn from this period of August to let's say the present. Because if you understand 40% of why these things happen, which I have worked very diligently and straightforwardly to explain to people what the real story is, not the, excuse my French, bullshit story that you guys hear elsewhere and what you read. Okay, but the real stories, if you understand even 30 to 40%, I can assure you that going forward, you will be able to manage your trades and not be surprised by anything. Disappointed on certain days? Absolutely. I am too, because it doesn't work on our timing. But as in reaching the goal, the fantastic numbers that we are presenting, okay, on a weekly basis, or on a monthly basis, you will be the recipients of that joy and the profits that come. So my goal is I have a very serious goal. My goal is to basically prepare people so they're not really surprised by much. Quick shocks here and there, but not like fully surprised, like, oh my God, why did it happen? And I'm saying, let's learn from that. I learn from the market every single day. Believe me when I tell you, I process that information and I share it with all of you. And these Sunday sessions, these coaching sessions, that's what I keep on saying over and over again to people who are sitting on the sidelines, not taking and participating in these sessions. Okay, that please, for God's sakes, do it, because these are so critical. So saying all that, this condensed a few months, August, September, October. Wow, it's like 3 months. The world changed. We went from being back to the Mayans, the landing of the aliens or whatever, the end of the world, as the Mayans to forecasted, right? Predicted, to like, whoa, hold on a minute, Jeff Bezos, what's going on? Google, hold on a minute. Facebook 103, like, oh my, so let's learn from this stuff here. So here's a macroeconomic background. Okay, you got this massive China stimulus, and notice one thing, they jammed the stimulus. I want you guys to understand this. Nobody will tell this to you. Okay, I've seen this happen before. They jammed the stimulus early morning Friday, pre-market, options expiration week. Not a coincidence. Why did they come out on Wednesday? Why didn't they come out on Wednesday? Why did they have to come out on Friday? Because they know, and I have tweeted out enough very powerful articles which all of you need to read, that the bulk of the institutional and these stupid, in my opinion, retail traders heavily in the short camp, they needed to blast them out. That's why you get SPX calls up 1,000%. You don't get SPX calls up 1,000% under normal events. It only happens when the majority is crowded in a little bear cub den talking about, oh, the PE is too high. Oh, the market's going to crash. I've seen this happen so many times, I can't imagine they never learn. Now, it does not mean you can't hedge. Don't take me the wrong way. But hedges should always be minimal. I've said it before, I say it again. What is a hedge? A hedge is an S&P put, a UVXY, or any other instrument that you use in order to hedge your long positions. So why should it be the majority of your portfolio? I still don't get it when members say, oh yeah, I'm going to be sitting on my UVXY and nothing else, and I just go directionally trade one side or another. Like, what? You're that amazing. I mean, it doesn't matter how smart you are. Like, you're really like some sort of all-seeing, enlightened trader who knows what's going to happen tomorrow. So you take one side of the bet or another? You can't do that. You have long positions. Maybe you 5% or maximum 10%, in my opinion, you hedge. So if the market does splat, like you have the Walmart sell-off, right? This was the big Walmart 250-point sell-off. Then you have these quick, what was the other one? I keep forgetting. All these mini sell-offs that you get within the primary trend of this channel. We are still in that primary trend. So why would you in the world try to basically say, oh yeah, I'm jammed into all the UVXY and I'm going to do great the next day. And the next day the market opens up 200 points and you are finished for that day. So please don't do that. Okay? Now, if the primary trend changes, that's a different story. That's a different story. And the technicals, which we're going to go over today and rehash and remember, we don't need to reinvent the wheel. We don't need to reinvent the wheel. We simply have to get better at understanding how these lines and how all these lines and everything that I draw, how they're working in conjunction with each other. All we have to do, we just have to specialize in learning that. We don't need to reinvent the wheel. This chart alone has generated significant profits for me. Just this chart alone. So why shouldn't it do for you? And that's the purpose of all these critical things. We just have to really focus and tweak and understand the interrelationships of all these lines and why these things happen and why we, what we can expect going forward and things like that. Okay? We don't need to reinvent the wheel. It's the same thing as government regulations. Government always wants to put more and more and more regulations on us. You don't need to regulate industries and companies to death. All you have to do is enforce the current regulation that's there. Okay? As a true capitalist who believes that wealth accumulation is prime for your own self-worth, and more importantly, once you're self-sufficient, wealthy, then you go ahead and help as many people as possible, the unfortunate. That's called benevolent capitalism. That's what I believe in. Because after all, you're a human. You're not God. So you can be a billionaire. Make that billion, man. Just do it. Make that million. Make that 100,000 on that trade. And then give away 5, 10, 15, 20% of your money. Help the unfortunate, your favorite stuff. So that's my philosophy. So just the same thing with charts and stuff, in the sense that you don't need to reinvent everything every 5 times. You don't need to look at I'm not making fun of anything, but seriously, Ichimoku clouds and 5 different and 50 different indicators, when this alone can tell you how to manage your stuff and how to manage your head, which means in tandem how to manage your portfolio. So that's number one. So going back to the macroeconomic factor, you have the China stimulus in play. Okay, China's dead serious. As we speak right now, the Chinese plenum, which is the Chinese Congress, the most powerful body in the world. For communists, that's actually the most powerful capitalist body in the world, is working. I mean, they've already talked about it. This is just for the public edification and for the world to see. Okay, they are basically there putting, and they're all you're going to hear over the next couple of days is their 5-year plan. China has already shot out, and I put it out there for people to see, the Twitter feed that I have and the news article I put in there. You really want to make a lot more money? Then read those headlines, and sometimes read the body of the article. So this one that I put out there about a day ago, it says China Central Bank sees very normal growth of 6-7% in the next few years. Powerful. Whether they achieve it or not is not the issue. The fact is they said they're going to make it happen. And in China, when they said they're going to make something happen, they're going to make it happen. Period. That's the way they do business there. So that's a powerful statement. So the Chinese government right now is in the process of making sure that all the idiots who think that China is finished, and I joke around a lot about China too, but what do you call it? China is finished? They're going to choke, ladies and gentlemen. They're going to choke. Because Chinese growth numbers, and I said this 4 weeks ago, by the way, about 3 weeks ago, that the worst of the Chinese economic numbers is over for now. And even if they're slightly weak, the markets are still going to take it and run higher. Did not that happen? Look at every Chinese stock, from Alibaba to NetEase to Win to BitAuto, which is a long-term hold, a swing trade, one of the biggest movers on Friday. Not just Friday, overall. VIPS, all these companies, there's a bunch of others, up anywhere from 5 to 7% across the board. So if you're expecting another bombshell of bad things, like China's really going to come out and say, okay, we're going to grow at 3% a year and the market is going to drop 1,000 points, I am sorry, it is not happening right now. I believe that well, I've mentioned this before, I'll say it again. The Chinese market stability is very important to global market stability. It doesn't mean that just because Shanghai is down, we're going to be down. It simply means that it is important for the stability of the European markets. It's important for the stability of the US markets. So one of the top China analysts, forget his name, who predicted the massive downfall of the Chinese market over the past 2 years, basically has said the Chinese market, the Shanghai market, will be up an average of 25% or so to about 4,100, something like that, the number on the Shanghai index between now and year end. Whoa! You want to say, if that happens, you know what Alibaba is going to be? $100. I think it's going to $100 actually. I don't even like the company. I think it's going to go to $100. Okay, so the point is that and then the first part of next year, starting January, you're going to start to see a consolidation. You're going to start to see a consolidation, and I believe that. I don't believe it at face value, but I'm just saying that that is very, very possible, and that is pretty much what's being played out right now. So China, one factor. Second factor is Europe. Look, Mario Draghi is not kidding around. Now, this is important for everyone, you know. So if you're bored with macroeconomic and you're like, hey man, just give me a good trade to make money. I give enough good trades. I don't need to walk on that. I give trades that blow people's minds away. It's them to act and make money on it. Okay, so we're gonna get there, but you got to understand the background so you can keep your good trades. Look, almost 99% of my trades are phenomenal trades. The problem is, and this happens to me once in a while too, is that you sell out too early. So instead of making 450%, you made 45%, and you sit there hitting your head on the wall. And make sure it's a soft wall, okay? Because I really don't want your head hurt. Seriously, okay? So and you sit there going, oh, excuse my French, shit. Oh, why did I do that? Happens all the time, doesn't it? I don't need to ask, I know. You need to manage your trades. And how do you manage your trades? Understanding the background a little bit more. So it gives you the mental confidence to say, you know what? Yes, I'm going to take 20% down. I'm going to take 30% down. I'm going to leave 40% in the book. And regardless of the fluctuations, I know it's going to get there because this is the background. That's the reason why I talk about these larger factors behind it. A trade is simply a vehicle driving through a very windy road. Okay, a very windy road. This is a very windy road. But if you don't know what this white space in the back, okay, or this black space in the black background, that's the global macro part. That's the domestic institutional money management part. So if you understand this background, you'll manage this road a lot better. Period. Simple. It is really simple. It'll give you more confidence to hold that trade. That's what I'm getting at. It is not the trade that I give you. I pick things at bottoms almost, when nobody is just touching it. Name it, whether it be Netflix, whether it be Amazon in the 400s, whether it be even Tesla at like 170. I remember a few months ago, everyone's like, oh, it's finished. It's going to go to 120. Yeah, right. So it's managing the trade that matters. So that's why this is important. So let's move back, jump up. Okay, Europe, big stimulus. Mario Draghi openly came out and said, don't mess around. I got enough instruments in my toolbox. It's like a James Bond movie. They think you have me finished. I still got that little tie clip that shoots away some poison gas. Okay, and so all kinds of stuff. So he openly said that. Market wham bang, just said boom, gone. Because they expected Mario Draghi to say that he feels that QE is working, European QE is working, the ECB mechanism and all that stuff. Okay, and that he's looking to slow it down within the next 6 months. You know what would have happened? The market would have fallen like boom, 300 points, and then realize, hey, he actually said something good. The economy is actually improving. That's why he's going to take QE down, and then turn around and go higher. But no, he basically said QE is in place, it's working, but we will stimulate more. Beautiful. What more do you need to know? He's taking a page out of what Ben Bernanke and Janet Yellen and all these people are doing. He's not going to mess around. It is a bigger risk to let the economy just float out. I'm talking about the European economy, to float out and to come out of that recession that they're dropped into, than keep interest rates lower. And not just that, of course, pump economy monies into the market. So that's a plus. Third thing, I said this before, and I'm going to be right. 70%, that's an exact number, 70 or 72% of companies that have reported so far, ladies and gentlemen, companies who have reported so far in the US have beaten their estimates. Now, how is that possible? When everybody said, oh my God, the numbers are going to be terrible. I mentioned something that some of you guys who focus know, a term, 5%. I mentioned a few times that the general consensus of Wall Street analysts was a drop of negative 5% or so on the third quarter earnings going into the fourth quarter. That's how negative they were on the market. Guess what? Some of these companies are not only making money, they are making money in bundles. What is the biggest area of growth? Remember, as a fund manager, and I worked in that capacity, not as a fund manager, we're in a team. Okay, you look for growth. So the only sources of real growth left is technology, which is exponential growth, viral growth, just the way our service is viral growth, man. A year from now, there's 1,000 people, and I'll be like, Julian who? I'm just kidding, okay? But seriously, okay, there's going to be like lots more people as the word gets around. And I don't even advertise in paid sites and stuff like that, okay? So the point is, so fund managers looking for growth. Technology is still a growth arena and pockets of it, not everything, pockets of it. And the other thing that I mentioned was that large cap industrials like General Electric, like McDonald's up 10%. That's when I wanted to hit my head on the wall because I was looking at that stock pre-earnings and I said, my God, why didn't I do it? I could have bought 1,000, 2,000 shares of that stock and bunch of options. They're cheap. They're not like Priceline options where you have to sell your house to buy one. They're like $1.50 max, maybe it's 80 cents. Boom! They were up 300% the next day. I couldn't believe what McDonald's did. So what did McDonald's do so special that the stock was up 10%? They finally unlocking some of their values. And I'm not just talking about cleaner bathrooms. I don't do McDonald's, so I don't know, okay? So the point is that they did something, they're doing something which is actually creating actual internal growth. Not 20, 30% type of growth like tech companies, but maybe 4 or 5%. That's good enough for the market. General Electric, they said, hey, yes, our revenues will down, but look at our bottom line. Look at our machine sales and turbine sales and all these sales, heavy duty machinery around the world. That's not really slowing down. Market's like, whoa, GE had their best quarter in 4 years. So when large cap industrials, let's not forget, please. That's the spy in the back. Let's not forget Microsoft. I don't even trade Microsoft, and I am a royal idiot. Microsoft was up huge, right? You guys know that. That's the actual E-minis as we're looking at it, live futures. Daily live futures. So Microsoft, for example, up how much? I mean, Microsoft chart looks better than like almost all of the charts that we trade. It looks better than Amazon's chart. It looks better than Priceline's chart. It looks better than any other chart I've seen. And that's Microsoft? So what I'm getting at, guys, is when you have large cap industrials, large cap tech, okay, not the IBMs of the world. That's large cap too, and that bomb, right? That went down hard. So should have shorted that. I was actually short IBM into earnings. Don't ask me why. So because I believe, Watson knows nothing. I'm just kidding. So the point is that that when you have these large cap, understand this, okay, please. When you have this large cap industrials, large cap techs moving, look at one of the biggest trades. I don't even know what my returns were on it. I bought them at how many cents? Like 40 cents. They went to $6 or $7 from my original thing. Can somebody tell me what it was? Let's say it's not technology. I know somebody who to tell me what it was because they paid a lot of money on it. And every time it was going, they were just screaming about it. Can somebody tell me what it is? It's a 3-letter symbol. One of the biggest recommendations in the past couple of weeks. What?
SBL.
Huh?
SBL.
SLB. You're right.
SLB. I'm sorry.
Thank you. No problem. Absolutely. Congratulations. Schlumberger.
Yeah.
Now, let me tell you one thing, okay? I never traded Schlumberger. That day when I recommended Schlumberger, you know why I did that? And that's the reason why you should tell every one of your friends and everybody to join us, because I'm constantly searching for ideas that we can play without trading everything in front of me. So I was looking at the earnings, what's coming out in earnings that day, and I was searching for one which I believed was cheap enough, was something that was that nobody was talking about. Nobody was talking about Schlumberger. It's in the energy sector, which is in the dumps. And all you heard was negative stuff about the fact that these big oil majors like Schlumberger, okay, were going to deliver horrific results. Well, guess what? Schlumberger did deliver results which were That day when I promoted it, Schlumberger went down. Remember that? It went up, then it went down. I kept on buying. I kept on buying because my charts kept on telling me this baby it's a kitchen quarter sink. I'm sorry. Yeah, kitchen sink quarter, whatever they call it. In other words, whatever the bad news was, they just took it and they threw it at the analyst. Said, okay, you want bad news? I'll give you bad news. There's no more bad news. Okay. And I knew the stock was going to do what it was going to do. I knew it. I kept up with it. And I told everybody, keep on buying this baby because it's going to 78 bucks. It's going to $80. Well, guess what? It went exactly there. So, and I've never traded Schlumberger. Well, I did a long time ago. So look at this chart. And you're telling me this chart can go higher? This stock will most probably go to $90. Mark my words. In fact, it's going to close this gap right here at $88. That's another 10% from here. So this was your earnings. Oh no, I think this earnings was here, somewhere around here. So the stock, nope, it wasn't here because I didn't buy the stock here. It was up here, yes, and then it went down to 73. It held this channel. My fault because I did it on a different chart platform. So yes, so Schlumberger. So when you have large cap majors like this, they're known as big oil majors. Okay, when they are moving like that, why shouldn't the market go higher? Why shouldn't the market go higher? This is real time, so I'm just showing you guys. Want to give your wife a beautiful Christmas present, holiday present? Well, buy her a lot of Schlumberger, and you see how happy he or your other half, wife or husband or boyfriend, whatever, will a girlfriend will be happy when this stock goes all the way up here and higher. So this is it. This is a beautiful pattern symmetry. In fact, I'm noticing for the first time, by the way, with you guys on this platform. This is a perfect inverted head and shoulder, not a dragon bullish. This is the inverted head and shoulder with the head down here, extreme bullish engulfing on the daily, extreme bullish engulfing, and top of the Darvers, 85 bucks. There you go. Another clueless 8 trade you have. Play it. Buy the 8, I'm going to put it out there. Buy the 85 calls going into November. Okay, so there's breaking news, by the way, from China. As I'm standing here in my command central, I'm looking at Bloomberg on the other side. They're red breaking news in their red letter boxes that the RRR, that's reserve ratio, Chinese, they're saying that their cut in interest rates will not affect their balance sheet. So let me explain that in a second. Okay, what does that mean? That means that, and futures are going to go now, and I don't care where it goes. I mean, the market's going higher at the end of the month. So what do you call it? Means that what is the thing that you hear all the time, that if we do QE, it expands our balance sheet by trillions of dollars. We're carrying more debt. Eventually it's going to kill us. You listen to Santelli, you feel like jumping off a building. America's finished. We don't know what we're doing. Central bankers are all idiots, and all kinds of stuff. Well, China just came out and basically said, look, we did that cut in interest rates. It is a form of QE, quantitative what do you call it? Why am I having a? I'm having like a what do you call it? Memory block. So you're getting QE, but we are not going to. Yeah, I just had a memory block. I'm like, what's the E? Of course, quantitative easing. So yeah, I know. It happens, man. You're talking a lot, so so I'm just like, oops. So anyway, so China just basically came out and said, hey, we did that, which is a form of QE, but it's not going to expand our balance sheet. What does that mean? Simple English. That we're not taking on more debt just because we're cutting the thing. Markets love hearing stuff like that because after all, debt eventually is bad stuff. No question about it. And excessive debt is worse stuff. But there's a lot of different mechanics of the fact that our debt service in the US, because of the suppressed low interest rates, has caused us to shrink our deficit, which is a huge thing. Our overall national debt has actually gone down because the debt service, okay, the debt service, the interest you pay on your debt, on your credit cards, on your car loans, on your mortgage or whatever, is very low. So the same thing's what central bankers do. So the fact that they said that they are not expanding their balance sheet, in other words, on the other side, on the right side of the ledger, they're not showing a bigger number on the debt side, is good. The world, the world wants to hear that. Whether it's true or not, I have no idea, but I don't care. That's what they just said, and that's an important headline. So the next, yeah, this number J here. Okay, let me move back to the SPY. So those are the macro factors going on. Earnings are coming out where these bulk of these earnings, these big ones, the GEs, the Microsoft and stuff, pretty big. I mean, they're powerful. They set the tone. Now, remember, we have a whole bunch of other earnings coming out. And what I like about the market now is that they are selectively punishing the ones they like, and they're selectively, they're not just taking everything up. Okay? They're not taking everything up. They're selectively going out there and they're punishing what they feel is not something that's good enough in their book. Okay, so that's good. So that's good. It's not like everything. So just because some of these earnings went up doesn't mean that the next set are going to be equally good. It all depends on the market, and that's what we're going to talk about, the pure technicals of what I think will happen. So bear with me 1 second. I want you to look at this chart. I'll be back in about 10 seconds. 1 second. This is a chart of the SPY. This is your high for the year, which was back on May 20th. On May 20th. And I wouldn't be surprised. It's called a 6-month cycle, that from May 20th to the middle of November, which is pretty much the end of all the earnings and stuff, right? Pretty much by the first week of November, second week, that we hit this number. We could hit it actually prior to that, but so that's the high. This is where we are. So look at this for a quick 10 seconds, and I'll be back. Okay, so stay put. Thank you. Okay, let's focus here. Bear with me 1 second. Okay, I'm back. So let's go into the technicals right now. Let's look to see what the downside can be. And believe me, we're going to come into a nice 300 to 400 correction, point correction very shortly due to technical, not just overbought conditions, but I think on a short-term basis, a lot of firepower has been expended. That simply means, in simple English, a lot of money has been driven into the market. Traders are starting to get a little bit happy. Sentiment behavioral indicators are starting to perk up. First signs of a little sell-off. You know the best times to buy when our room is dead quiet and I'm waking everyone up and saying, hey guys, you know what's happening? And not a single voice is out there. So that's obviously the best time to buy. The other best time to buy is when which I think is still available. I mean, still we have a window of opportunity to go higher. Is that a good portion of traders, and investors forget it. I mean, mom and pop is not even in the picture. So a good portion of traders have missed big time. So now they're just sitting around waiting for the infamous 500-point drop, in which case, hopefully, they buy, because a lot of the times they don't even buy then. And it's not just traders. Same thing with the money managers and stuff. So, so we still have an opportunity. Not that everybody is participating. Groups like you are obviously benefiting selectively from different trades and really playing it hard on the returns. And congratulations to that. So obviously your confidence level has gone up, and that's a key ingredient of winning on the next trade. It's key winning of the two ways that confidence is hurt. Just remember that in trading. One, because you did it and then the market slapped you the wrong way, and you're like, oh man, I shouldn't have done that. That's one way. Second way is that you didn't do it, which is really what's happening right now, and the market went up like a wild monkey, and you're like, oh man. So that is, in my opinion, worse. And repetition of that same behavior is deadly. And unfortunately, most traders do that. And that's why I always say human behavior never changes. Never changes. Okay? And all we do is we adapt. We adapt. So if we are going to adapt and refine some of our bad habits, then let's do it. We'll never change as mortal human beings. The inherent nature of a person does not fundamentally change. What changes is their is whether or not they are trying to refine their behavior. It doesn't change their nature. Remember that. There's a difference between behavior and internal nature. The internal nature of the markets, of the financial markets, and of our lives don't change. Either you're a good person or you are, excuse my French, a shitty person. Period. Don't fool yourself. And if you're a really shitty person, then accept the fact you're a shitty person, and you'll be a better person. I'm not kidding around. I'm telling you the truth. So the same thing with the markets. Okay? Acceptance. Don't be in denial. When you're in denial, you will never be a successful trader. You will never make real money. Don't be in denial. Accept it and try to refine it. And it'll take some time, and you will see basically the fruits of that labor. So saying all that, market psychology is the same way. So here's a couple of things here. Let's hit the technicals here for a minute. We have the SPYs, which we follow very closely, obviously, for the market. There is a very simple pattern symmetry, if you want to look at it pure, very on a simplistic level, which is the very large dragon bullish formation. This, by the way, this running tail, inverted hammer, dangerous. You ever see something like that? You want to get out of Dodge for at least a day or two and see what happens, because these are dangerous, and especially when they're happening off trend lines. So I will not lie to you. Actually, I drew the trend line after this reversal, so that was point number 2. But anytime you see a reversal hammer like that, and if you have profits and stuff, it doesn't mean it's going to do a complete move down, overall zigzag down, but it's normally not good. Here we had reversal hammers too, but then they turned around the next day, right? So because it came to the bottom of the Bollinger or the acceleration band, so there was levels of support, which was this at that time. But in general, not good. So anyway, so we have a powerful dragon bullish formation. It's also inverted head and shoulder. And right now, just like a wave, we're creeping higher. Most I can see it going is 210.68. So 210.68 from where we are right now is what are we talking about? We're talking about another 120 to 150 Dow points. Write it down somewhere. And if that's the case, we're looking at about 17,800. I don't know. I really don't know if in October, which we only have 5 business days left, by the way, that we're going to hit 18,000. But 18,000 is a magnet. It's a psychological magnet. And the market might want to just do that for the fact that it builds psychological confidence. When a guy who knows nothing about the market, or a guy, or the hundreds and thousands of guys, on the other forums who are like, oh wow, market's down, we're finished, and then oh, market's up, we're going higher. For them, round numbers are exciting. Oh, we crossed 18,000. Oh my God, we broke 16,000. We're finished. 18,000. Oh, everything is great. No, it's just numbers, guys. It's just numbers. It really means nothing. So bottom line is the media and the invisible hand plays like that. Okay, they want to excite people, like, oh, we reached that point, or we didn't reach that point. So that's why 18,000 is a magnet. Anytime a round number is a magnet. So here's the interesting part, ladies and gentlemen. I just noticed, okay, I actually knew that before, but I'll repeat that this is the last week of the end of the fiscal quarter for the mutual fund complex. The US mutual fund complex, ladies and gentlemen, is a 800 to 1,000 pound gorilla. So they are ending their fiscal year. Their fiscal year doesn't end on December 31st, okay? I've said it before, so remind yourself that it ends on October. So October 31st. And guess what? This is the week. October 31st is Halloween, right? October 31st is Halloween. Never short Halloween. Ever. Okay? You want that black cat to hiss at you? Well, in that case, buy 100 puts and sit there, and it'll rip your face off, okay? So do not short Halloween. Just letting you know that. Just the way you don't short Columbus Day weekend, you don't short Labor Day weekend, you don't short any national large type of holiday. Can anyone answer why? I've explained this a lot of times. Very simple, actually. Why? Why do you not short large national holidays or religious holidays and stuff like that?
You don't want people to be sad.
Yeah, so I don't want people to be sad. I don't want you to be sad either. What does that put money in my pocket? No. What you answered is the behavioral part of the question. What's the financial part of the question?
It's not good for institutions for the market to be down on major holidays.
Nope.
There's no money spent.
There you go. You said the answer in a convoluted way. There is no money spent. When people are depressed, when they're sad, both of you answered the right question, but you didn't get to the exact point. But you said it is they don't spend. What percentage of the U.S. GDP is consumer spending? What percentage of the U.S. gross domestic product, which is the total sum of goods and services produced in the U.S., what percentage of that? We are a $14 trillion economy, or 17 trillion? I'm losing track. But more than what percentage of that is consumer spending? You and your significant others going out there and buying things. What percentage of that, please? If you understand that, you're already like 20 steps forward than anyone else. What percentage is that? Google it. I don't care. But seriously, I mean, if you don't know that answer, this is the critical part of financial investing and trading. Okay, why is the GDP number so important? What percentage of US GDP is you and me or consumers contributing to it by shopping and by spending money? No one knows?
No.
Okay, more than 70%. If one day, if you stop spending money, and let's say we have 1 day boycott of buying from McDonald's or buying from Dunkin' Donuts or whatever, the US economy will collapse in 3 days. Why do you think in 2008 the government took such forceful measures? Because people were sad? No, because things were getting so out of control that people had actually ceased to spend. They were literally, there were worries about the money market breaking and that your monies in the banks weren't safe. Remember those headlines? That it's called break the buck. When you put money in your money market, you think that you put $100, $1,000, it's going to be $1,000 tomorrow. Do you know that if you read the fine lines, that's not the case? Because a money market is $1 per share. It's not cash. It's money market securities, short-term securities. So there was a fear. It's called breaking the buck. That if your $1,000 that's in the bank might be worth 980 or 990 the next day. So what do you do in that case? Go out and buy that, $500 Gucci scarf? No. You sit back. Consumer spending, ladies and gentlemen, on our U.S. economy is just is huge. That's why you don't short in front of major holidays. All right. So another interesting fact that you learned, which you can share with at your next cocktails you're having with your colleagues. All right. So the point is, it's the funny part is that most people don't know that. They think, oh no, it must be heavy machinery or Boeing or whatever the case might be. It's not. Okay, consumer spending. So that's why you don't do that. So let's move on. So at this point, 1 second, just looking over something. So at this point, we have a holiday weekend coming. Halloween is a very large holiday weekend, by the way. Okay, and you obviously it's something very large shopping weekend. So going back to all that, realistically speaking, I'm looking at about 210.68. That also completes this pattern that I kept on talking about. And that's on a daily basis. Now, prior to that, what do you think might happen? We probably get a quick, sharp pullback into the Federal Reserve meeting. Let's not forget, it's this week. The Federal Reserve meeting, ladies and gentlemen, is on. Look at this here. I'm looking at the other side. Today is the 20. What day is it today? 25th. Okay. Okay. So the Federal Reserve meeting, I believe. Oh, perfect. You want a day? You want to know a day we're having a nice little sell-off? Wednesday. Write it down. I mean, you want real forecasting? I've done this so many times. It's like magic, right? Magic. We're going to dip and then they're going to run. And we're going to end the week on a strong note. With the disclaimer that I might be wrong. So what? I've been more right than wrong, so who cares? Okay, so yes, Federal Reserve meeting, serious note, is on Wednesday. These are the dates you have to watch out for. Please, and you can access this site yourself. So you can certainly do that. So here we go. Very important. You have tomorrow, you have, we already got the China stuff out of the way. Chinese market right now, big time rally, up 1.3%. Alibaba probably is up $2 right now. Okay, so here we have, these are the numbers. US new home sales, that's going to be a strong number. Falls coming in. A lot of the interest rate fear hikes have been kind of moved back. Mortgage applications are very high. New home sale contracts are also pretty high. Building permits are pretty good, not out of control. I don't want to get into it right now, but very high building contracts is not good. That means there's an oversupply of homes, okay? You don't want that. You want a tight supply and prices, moving higher. So you have this, new home sales. You have the Dallas Fed Manufacturing Survey, somewhat important, not that big. This is the big guys, big movers, okay? FOMC meeting begins Tuesday, October 27th. Important number, US durable goods. Don't know what that number is going to be because this number is very dependent on large items like cars and planes, primarily aircraft. If Boeing actually just landed some very fat contracts with some foreign players, so durable goods could be skewed higher because of that. U.S. Red Book, important. That's retail sales. Case Shiller Index, and Mr. Shiller, by the way, is a royal idiot. Okay, you know that guy, right? Mr. Shiller. He's a brilliant guy. He's from Tufts. From Yale. The Shiller Index. That guy's been so bearish and negative on so many things, I can't even tell you. He's the worst trader. You'd cancel his service in 1 minute if you ever, But that's Case Shiller for you, okay? U.S. PMI services, inflation data, important. U.S. consumer confidence, very important. Very important. Lower consumer confidence, as we talked about right now. All right? Lower consumer confidence is bad for sales. So lower consumer confidence is not going to be looked on lightly. So be careful about this at 10 a.m. And of course, I'll remind people. Now, this is Japanese retail sales, doesn't matter. We don't really, the Japanese economy, honestly speaking, has never affected. I still don't know how the Japanese economy works. with all their hardcore deflationary numbers and stuff, and Tokyo seems to be rocking all the time. It's almost as fun as Madrid, but they're richer than Madrid, by the way. So the
Yeah.
thing is, but they don't have anywhere to live. They live in shoeboxes. Yeah, exactly. You get these cubicles you can rent for the night, and they're like coffins. You sleep in them and you get up. Okay, so Japanese are masters of space management. So anyway, try going to the Ginza district. Don't drink too much. So here we go. So MBA mortgage applications important. Petroleum status important. Oil inventory. Here is the big daddy of things. The big daddy of things. And on that note, I am going to make it red. How about that? And do this. Yes. So here's my idea of the market right now, okay? I'm not kidding. This is the way it works. We are most probably, if we have a sharp drop tomorrow, let's say, for whatever reason, I believe it can be bought. If we have a sharp drop on Tuesday, I'm going backwards. If we get a sharp drop on Tuesday, then Wednesday is going to be higher. Okay? If we rally into Tuesday, and I'm talking general market, not specific earnings and stuff, which we'll be playing, but general market, if we basically run into Tuesday, after a little drop on Monday, let's say they start buying, and then we run into Tuesday, take down any large trading positions. Do not be a hero in front of the Fed FOMC meeting. We know that the Fed's not in a rush to raise rates, but why bother with the market reaction? Because the market will react to take your money away from you. So if you're sitting on any sort of decent profits on any trading type of position, please do not be ahead of the FOMC meeting. All right? And that's the Federal Open Market Committee meeting. So one second. Just remember that, okay? Very important, because I won't be. Doesn't mean I'm going to take down all long position. I'm just saying, like, don't leave like 20 contracts or something like out there, because the algos and the high frequency trading programs will rip your heads out and take that money from you, because there will be turbulence. So this is a volatility event, right? We know that it's a volatility event. Then we have here, let me clear all this out. So then we have, oops. What happened here? 1 second, please. Erase all drawings, go back. Okay, good. Is everyone with me so far? I forgot to ask that. Or is anyone lost?
Yes.
Is everyone with me? Rimik, you still with us? Okay, Rimik is new, so the person hasn't taken she hasn't taken the introductory courses, but I'm sure is picking up on this stuff. But all right. So we have this Japanese bank announcement. This is important. This is early in the morning, late at night, actually. And US GDP, bingo. US GDP. What can I say? We just explained to you, more than 70% of US GDP is consumer spending. So this is somewhat connected to this. But remember one thing, this is basically going into the game theory aspect of it. I've always said that I will explore that and as time goes on. The game theory aspect is that when we get a lower consumer spending number, it doesn't mean that we are stopping spending or lowering. It simply means maybe the market was down 600 points the week before. So we're feeling a little crappy. Even though most Americans don't even have direct involvement with the stock market, but they have a significant involvement with the stock market through 401ks, mutual funds, and such. So they do have an involvement in the stock market. Their IRAs are invested in the stock market. Their IRAs are not sitting in cash. When the company check takes their IRAs and the 401ks, their contributions, they are put in the market, correct? So they are indirectly connected with the stock market, even though they are not directly trading or maybe adding to Apple and Win and those companies. So US GDP, so this number here, the confidence numbers, just so you know, does have a market impact, because algos would like to create some volatility, down 100 points just on that news type of stuff. And that's why technicals become so important. And that's the last thing we'll cover tonight. And so we have that, but it doesn't have a direct correlation with GDP. because this is more fluctuating. Depends on, whether you're in a pissed off mood or you woke up on the wrong side of the bed kind of thing, okay? This one. Unless it drops below a certain number, which in my book is around 80 or 70. If US confidence drops below 80 or 70, that means something is going desperately wrong. And the last I checked, Americans want to spend quite a bit going into the holidays. With gas prices where they are, you think they don't want to spend? Of course they want to spend. All right, so it's good. So U.S. jobless claims, important, not that important. And pending home sales is good. I mean, is also important. The home figures, 1 second. So all that is good. Then you have, so basically the hump we have to cross is Wednesday. Unless the Fed, I want to warn people, then US GDP on Thursday. Now, remember one thing, the Fed meeting announcement, and you're going to hear this on the news, so you heard it here first, okay? They're going to keep on talking about the fact how the Fed meeting is a day before the US GDP numbers. Big deal. The Fed already knows what the US GDP numbers are going to be. So if you have soft GDP numbers and the market drops, please, of course, within technical levels, buy the market. Because that means the Fed has pushed out the rate hike cycle into first quarter of 2016. Now follow this very carefully. If we get strong GDP numbers, then they're going to look back at what the Fed said and they're going to say, uh-oh, rate hikes coming real fast. So we don't want too strong a GDP number. Just reminding people, okay? Just so you know that. If the GDP numbers come above 3 to 3.5%, believe me when I tell you, the market's going to drop 400 points fast, pronto, because that means the U.S. economy is accelerating to a degree where the Fed is going to come in quickly to raise rates, which itself is a buying opportunity because the markets don't start to change direction till the third or fourth rate hike. That's long-term projections, okay? Because after that point, it starts to hit corporate profits. So anyway, so just, passing it on to you. And then we cross all this stuff and we get into Friday. You start bringing your Halloween masks out and whatever outfit people are wearing or not wearing. And this is Friday, okay? So Friday is kind of a meaningless day, actually, to be honest with you. Employment cost index, Chicago PMI is important. So remember, going back to it without spending too much time, Wednesday, Fed meeting. So it's a very important week, and we want to be very strategic like we normally am, or like what we normally are, with our trades and such. All right? So let's keep that in mind. So here is your market for you. Here's your market roadmap going into this week. And generally, my market roadmaps have been pretty deadly correct. So I hope that it's going to seem the same this time. All right, let me get the drawing tool. Uh-oh, Twitter is going to fall tomorrow. Maybe not. They're reporting right now that Steve Ballmer, the ex-CEO of Microsoft, does not want a board seat, but he owns more than 4% of the stock, right? So it could be something interesting. Initial reaction could be down, then you buy it. He still owns more than 4% of the company. You know that, right? So Twitter did extremely well on Friday, but Facebook's going higher. All this live, by the way, is breaking on top of my head on one of the flat screens. Facebook just won $15 billion on dismissal of a $15 billion lawsuit. And here's the dumbest headline of the world. Abu Dhabi sees higher oil prices in 2016. Oh, man. Don't let me start, okay, on those guys. They're so wrong in directing their own only asset that God has given, and they make so much money off it, and they still can't figure out where oil prices are going to be. Does anyone need to tell us oil prices are not going to be higher in 2016? Okay, so forget it. So here we go. So right now this is the level, ladies and gentlemen, that we are covering. Notice a couple of things here, going back to fundamental technical analysis, like from the first day. We have a channel, this channel, right? The orange line. Everyone sees that?
Yeah.
Yes. Okay.
Yes.
A couple of things here you need to notice what's happening on the charts, which is extremely powerful. We have a 34-day, this line here, this line, okay? That's the 34-day moving average, this line. Let me just change the color of this pen because red doesn't show up here. Hold on. This is extremely important what I'm going to explain right now. So please focus. Let me pick up yellow. Okay. Okay. This here, this line here is your 34-day moving average right there. This orange line, okay? This is your 50-day moving average. Remember what I've always explained. When you start to see the 50 and the 34 starting to curl up, you are going to be on the verge of a pretty explosive move on the market up. When this 34, it doesn't happen in one day, it takes a couple of days. When this 34-day moving average, this orange line here, dark orange line, crosses over this red line, which is the 50-day moving average, like this, and then the 50-day moving average follows. Ladies and gentlemen, you're going to make new highs in the market by that time. And no one's going to ever believe that could ever happen. However, it's not a smooth one linear process. I've always said my famous line, the market is not a linear animal. 1 + 1 doesn't equals 2. At this point, and people who are taking the, people, most of you know because you know about standard deviations and stuff. So for somebody new like Rimik who's listening, Rimik, you can still hear us, right? Okay, she's listening. That standard deviation and somebody who's, basic math, I guess, that you move away. What's the distance between your mean? So your mean is basically your 50 and the 34. All right? Your mean is your 50 and 34. That's the highway you follow. So anytime you fall completely out of the highway like we did here, there's a very good chance that you're going to somehow get towards try to get back on the highway. Well, guess what? That's what the market did, if you remember. Okay, back in September. It came almost to the highway, went over the 34 and then to 50. And then the market pulled a fast one on us, right? We still caught it. It was a false breakout and it was reversed, created a double bottom, all pointed out, all benefited from. And now we are trading in this channel. So at this point, if we do see a 34 crossover the 50, that means this market really has a lot of room to go. This does not happen in one day, I warn you. So the minute as we get closer to this, we're close, we're not there yet. What's going to happen is the market's going to do a quick correction. All right? So let me show you what the correction is going to be. All algo, all mechanical. The correction, as many of you know, many of you study the charts well, is we have a downtrend line here. Actually, let me go back so people can see it. Excuse me, 1 second. Weekly chart looks fantastic. I can't even tell you. It really looks great. And just when it looks great and it feels great, sell the market. Remember that. So but it has to be based on technicals, not on our emotions. So bottom line is that at this point, see this line here, the red line? Yes, the red line is your downtrend line. A downtrend line from the highs, which was 213 or 2140, I believe, on the S&P, right? That was our, let me look at my other screen and show it to you guys. The high on the market was 2134.71. So it's close to it, right? So 213.78 is on the SPYs. On the S&P, it's in the S&Ps, it's 2134.71. People who are not very well versed on understanding SPY and SPX levels, I suggest that you jot them down as I'm telling you. Okay, so you can kind of refer back to it because it is a learning process. So bottom line is I drew the downtrend line from the top, touch this, and here. Once we broke out on the 22nd on Thursday to Friday, right? The bang move up. Guess what we did? We broke out of the downtrend channel, huge short covering. Algos know. They have this number programmed in that if we broke this downtrend channel, if the market broke this downtrend channel, there's no looking back for the next full trading day, which was Friday, and the next full trading day, which is going to be Monday. So at this point, the market basically has resistance at right here at the top of the channel, and that's around 208.51. I've showed this in my other charts. If we break out of that, then the most we can get to, I don't think it happens tomorrow. but who knows? Don't forget that it's the end of the fiscal year for mutual funds, and the portfolio managers only have 5 days, 5 days starting tomorrow, to add new positions or bulk up the existing positions that they have. In other words, they want to show the winning stocks in their books. That's just the way the game works, okay? I did put up a fantastic article on Twitter. I want everyone to read it tonight. Please, please do. It says, and I've said this for years, and now they're writing about it. It says loser fund managers may be what the stock market needs to go higher. You guys remember? I know some of you do, that I keep on talking about the fact that none of these bozos want to lose their jobs. The market, if the market's up 15% and they are making 5%, that's a 10% net gap between meeting the market. So they are basically lagging the market by 10%. Just giving you a hypothetical example. If they keep on doing that, what happens? Their investors, even regular Americans, they're like, I don't want to send this guy money. The market was up 15% and this guy just gave me 5%, and he's been doing this for 3 years. So I'm tired of it. I'm moving my money elsewhere to another mutual fund. You get it? So mutual fund. So this is an extremely important article if you understand the behavioral dynamics of money management. It says loser fund managers may be what the stock market needs to go higher. In other words, they need to show the winning stocks in their books that they never bought at the lows. They weren't touching Amazon at 400. They weren't touching Priceline at 1100. They were not buying Apple at 96. So what do? They have 5 days, ladies and gentlemen, to show some of the positions in their portfolios. And that's where you get that window dressing rush as we get into the end of next week. Just follow that, or just remember that, okay? So saying all that, at this point, we could get a quick pullback, which I would welcome. And that would be up testing the downtrend line right here. So it would be something like this. One sec. Something like this, okay? What we don't want to see, so that would bring us down. So that would be roughly about, let me see, 30. That could be like, yeah, from here to here is about 200 Dow points. So don't freak out. You want to be careful. You don't want to put some heavy duty open positions at this level, because right now the market's on a high speed momentum move up. But before it gets to this level, mark my words, okay, it will pull back. It needs to, like a slingshot. Remember, I do the slingshot analogy. So you pull that slingshot up, you create kinetic energy. It's physics 101. Even though some of you might have failed physics 101, just remember that, okay? When you pull, when you develop kinetic energy and you let it go and it goes higher, markets do the same thing. They pull back first before they move higher. Always remember that. Okay, so the same thing here. A pullback here would be roughly about 100 to 200 points from where we are right now. Nothing to worry about. Nothing to worry about at here. What does worry to worry about? Even in fact, even if the market pulls all the way down to the bottom of the channel, to SPX, to S&P 2000, which will be like all the bears are going to come out again. Like, oh my God, this is it. This is the end of the market. It means nothing. It simply means that we are, I call it channel surfing, like this. That would be a pretty sharp move. Can it happen? Sure can happen. I'm showing you the downside here, ladies and gentlemen, okay? So even if we drop here, from this point, the market basically gets up towards the top of the channel too. If we drop here, there should be a fantastic buying opportunity again. You'll get some stock cheap. And then it moves from here, loud. So that's number one. And let me just show this a little close up so people can see it. Okay, that's better. So scenario one, on a pullback, we need to hold around 204.50, 204.68. What we don't want to see is these lines. See this yellow line here? And I'll be showing this chart too, so just make sure you understand when I show it. This yellow line is your 5-day moving average. The 5-day moving average, as I've said, is your trader's friend, because this is the short-term momentum. Notice how the market likes to hug the 5-day moving average. See? So anytime you're above the 5-day moving average, you're good. When you start to fall and you have a quick correction, well, if you're long, you feel crappy. This was the Walmart sell-off. from nowhere, if you remember that day. Okay, so so this was something that, but it held the held the moving average and all that stuff. Anyway, I don't get into it. So bottom line is, this is good. If we start to see the 5-day moving average, listen carefully. If this starts to turn down, do not be a hero. That means that the fast money that goes in and out of the market, the hedge fund money. Remember, hedge funds have no loyalty. They're like hyenas. You ever watch Discovery Channel? You know what hyenas do, right? So they are basically, hyenas are scavengers. Most hedge funds are scavengers. They let the mutual funds do the killing, and they come in and eat. I'm serious, all right? I'm telling you the truth. Okay, they're a bunch of fast-moving scavengers that use very high-level, high-frequency trading programs to generate profits in the market. Most hedge funds do that. Then there are big hedge funds who sit on, there are all types of hedge funds. Then there are big hedge funds who basically sit there and invest, take activist positions in companies and stuff. But I'm talking about the fast-moving, high-momentum, day trading type of hedge funds. You know, when Priceline is up 30, then down 20, and Amazon's up 7 and down 3, and I'm like, okay, technicals look good, buy, and everyone's like, what? And then they buy, and it goes up another 300%. That's the hedge funds trading. Okay, so that's the hedge funds trading. So we want to make sure that the 5-day moving average does not change direction. So that's key. Worst case scenario, we need to hold this level here. This is not only the bottom of the channel, ladies and gentlemen, it is also the intersection of the 50 and the 34. The last thing you want to see, and anything can happen, so let's be prepared, that this 50 and the 34, which is starting to turn up. Everyone can see that, kind of? It's starting to curl up.
Yes.
Right? If it goes like this, and believe me, anything can happen. For people who are not new to the session, like Rimik, let me explain something to you. When algos and HFTs control the market, as they do, they can change patterns in 5 minutes. Do not be surprised. I always come in, I put out the warning out there, and now I do the Periscope, so I'll definitely show it during the day. If we start to see a turn, a negative reversal of the 50 and the 34, short the market like crazy. Because that means we are going to come and test this again. And that, if it dropped from here, I mean, obviously, I don't know, it can happen. It dropped from here to here. You put $10,000 here, or multiples of 10,000, whether it be 1,000 or, I don't want anyone to play $100,000 options, that's for sure. But let's say, 10,000, whatever. This 10,000 here will be close to, I would say 200. Okay. Yeah, 200, 1,900% or more. 10,000 to 200,000 is 1,900%, ladies and gentlemen. Okay, not 20,000%. I mean 2,000%, 1,900. People who know how to do percentages, they know what I'm talking about. So this is a 1,900% return on your money. I wish I knew that was going to happen, but just be prepared. If we get a very sharp drop and we start to see the market fall out of this channel, we are going to drop here real fast. All right, so that's your downside. Little pullback, consolidated pullback, fantastic, love it. Make it happen. It'll be great. And then a slingshot move up at this level. Please be warned. Do not attempt large buys. Yes, the market can give you a false breakout like this. Now remember, this is a daily chart, right? So obviously things are slow moving. Notice how my lines intersect with the bounces and everything. See? This blue line here, because this is a large rising wedge. Can everyone see that? See
Yes.
the blue line? Yes, please focus. So here's this thing, here's this thing here. This is a rising wedge. Rising wedge. I actually got a very fancy graphics pen I'm going to start using, so I don't have to use my mouse to write. So here's the rising wedge. There, culminating here. What happens at the top of it, when you hit the top of this rising wedge, given where we are right now, obviously we get an overshoot, in my opinion. But once we get the overshoot, please take down any trading long positions, short term. I'm not talking about the swing position or investing position. I'm talking trading positions. So because at that point, you will automatically get a pullback to the bottom of the wedge, and then the market will decide what it wants to do here. If it slips, it comes to test the channel, this channel, right? Top of the channel. And that can happen without even going there. That can happen tomorrow. But this is the warning zone, okay? Because once it gets there, you have completed a massive pattern in 60 days. So you don't, you need to, it doesn't mean you need to short, but I will certainly have hedges on the short side at that level. Okay, so just remember that. So on the downside, this is the line that I'm watching, 204.25, 205.38. Of course, maximum deterioration, and I'm not going to be sitting there long. I'll be shorting hard. And I'm going to talk about trade management in a second. So that's around 199. Break 199. You're looking at 197.93. That's the support here at the 34.50. We break that bottom of the slope, bottom of the channel, 195. Break that. Of course, it's not going to happen that easy, but who knows? So if it breaks 195, see you later. Don't be a hero. The market wants to, at that point, go down and fill this gap. There's a gap here, by the way, 188.60. Okay, let's not forget, there's a gap here. And gaps do get filled. I don't know when, but this gap gets filled. It's going to feel like the world came crashing on you if you're holding too many long positions. All right? So just remember that, because that's a very large drop. That's a 600-point drop on the Dow. Can we drop 600 points and go back to 17,000? Yeah, we can. Is it going to feel any good if you're buying and you're holding something? No. So that's why you need to have a hedge. Am I clear on that?
Very.
Okay. And hedges are S&P puts, RUT puts, whichever instrument you want to use. UVXY. You want to use what's the other one? There's a bunch of them. I like to keep it small. I like to keep it towards the S&P side, to be honest with you. They make me the most money. 100-point drop, the S&P puts or calls go up, 100%. What more do I need? So, and you don't even have to buy that much. So that brings me to the trade management issue here, okay? From a trade management standpoint, please manage your trades so you don't completely, manage your trades so you don't completely blow up on one trade or another, please. Small gets big. What does that mean? I've noticed over the last 6 to 7 months that, let me show you in real time what's going on with this thing here. This is the actual chart of that same SPY, except it's the E-minis, the futures, right? So the futures are right now showing on this is the daily futures. Let me go back to the 1 hour. Everyone see this?
Yes.
What is this channel called? As this futures right now are down about 2 3/4, 3 points. What is this channel called? Once you go up like that, what is this channel? It's called the consolidation channel, okay? This is a consolidation channel. Futures traders who basically are trading the futures right now are using this as a move. Now look how it's falling. So what's the lower end of the drop that it should hold? It's the lower end of the DARVA, so 2056. So all of a sudden, if you see futures right now drop 7 points, somebody who doesn't understand and somebody who's not taking these sessions and stuff, they'll be like, oh my God, I'm watching the futures. They're down 7 points. Something really bad is happening. Nothing bad is happening. It simply means that there is a reset going on, because by the time it falls 7 points, this 1 hour, as we all know, gets reset. This will get reset. Whether it happens overnight, which would be good, or whether it happens tomorrow, we are going in for a reset. So this is a quick reset. So this would be the level. Now remember, all charts are fine so far on the futures, so we're okay. And just like the SPYs, you can track the futures, and overbought conditions can remain overbought for a bunch of days. So the same, just like the SPYs, we want to hold the yellow line, the 5-day moving average. That's 2040. You hear a lot of these big shots on TV talk about S&P E-minis 2040. Right? So right there is your 2040. That is coinciding with the channel, the downtrend line. This red line is the downtrend line. Can everyone see that?
Yes.
Yes. So that's the downtrend line, and that's 2043. So slippage below that would bring us to the breakout level. See this green line here? This green line was the breakout. So that breakout is 2016. So if we get to 2016 and fail, then things are starting to get a little dicey. And I explained that on the SPYs. So we should be able to hold 2016. Remember, 2016 to where we are right now is how many points? It's 46 points on the E-minis. Yeah, it's 46 points. So do the math and write this down. That means a drop of about 300 to 350 points on the Dow. So just because you see a 300, 350 points on the Dow doesn't mean it's panic time. It simply means the market basically has come and testing the breakout level. So, just keep that in mind, stuff like that. It could be the start of something big to bring us lower, or it could be simply a pullback, and that's something we'll have to see. In the meantime, we do not want to see on the futures 2045 or 2046 being broken, because that means a short-term change in direction. All right. Now, given the seasonality of what I explained about the mutual fund complex finishing their fiscal year by October 31st, Halloween, boo, okay, and all the other factors that are in play, I do not expect any sort of massive sell-off in progress. So there is a bullish bias over the next week, ending in Friday, and November will be November. We'll take that one step at a time. So from a money management standpoint, don't trade large positions, and if you have the ability, track the market in real time. I'm always putting out my alerts and stuff like that. Some of the biggest winners we have had over the past couple of weeks have been earnings, correct? Earnings. So the point is that we are going to be selectively playing earnings. We have some big ones coming up, and in the earnings fronts, this is what I play. And I just want to explain this to people. I love buying common stock, honestly speaking. Yeah, I love buying the calls too if they go in my direction, right? But at least the ability to sell common stock or get out and manage your losses after hours, I mean, what can I say? It is huge. So when the Amazon, which was one of my biggest winners, one of my biggest winners, one second, there, by the way, Amazon on the daily doesn't look good, just so you know. You see that red doji? I mean, the red candle at 600?
Yes.
Yeah, so that, honestly, I mean, I would actually short the stock right now because that's not good. So either it holds 594, 595, and you know why it's not good? Because the standard deviation from and it's not just Amazon, a lot of stocks are like that. Standard deviation from the 530 level to here is too wide. That's almost a 4+ standard deviation. Okay, so it needs to reset a little bit. So I would love to be a big buyer of Amazon 20 or 30 points lower, just so you know that. All right, so just letting you guys know that. So will it give me a chance? I don't know. It's too powerful a company. A 1 hour has fully reset. Look at that. That's nice. So this is definitely tradable on a short-term basis. So that's, so when you do play did somebody just join us? No. So just one second. So let me write that down. People who missed it, they're all asking for tonight's link, so I just have to keep an eye on that. So here's a couple of things that I've used very successfully for myself. Buy little stock. On the big movers, you generally move 30 to 50 points, correct? 30 to 50 points. So even if you buy 100 shares, come on. If it goes the right way, which generally we have been hitting some real good nails, you're cleaning out a couple of $1,000s for 8 minutes work. So let's not get stupid, okay? So if it's falling the other way, get out. After hours, you can get out. But for that, you have to be glued to the screen. If you buy options, this is the problem I have with options sometimes. The premiums are so stuffed, meaning right before earnings. Like LinkedIn is the next move, right? Is the next one I'm focusing on. LinkedIn's chart looks fantastic. But most probably what I'm going to do is as I get into the, as the premiums get bloated, I will sell my calls that I bought. And LinkedIn was huge winner, as you know, the lotto winner. They went from 99 cents to $8. Thank you very much. And I was begging people to buy them at like $1 or something, right? Exactly. It doesn't take much. What was that?
You are correct, yes.
Yeah. So I didn't know. I just liked the chart. I like LinkedIn, but that doesn't have anything to do with anything. The fact is that even if you made double that, it's still a double. And lottos are lottos. Put a couple of $100 in there. Either they go to a couple of $1,000 or you lose a couple of $100. So good. Don't eat Chipotle for the next couple of days. Big deal. No, I'm serious. Lottos are lottos. You gotta. That's a gambling money. So let's say you say I have $400 worth of gambling money and I want to just throw it in there. Throw it in there. If the 400 goes to zero, fine. At least you were in the game. But what happens if that 400 goes to 4,000? Does that feel crappy? Yeah, that feels 20 times more crappy than 400 going to zero. So that's the way you think of lottos. Lottos are simply monies you put in there. And of course, I'm not saying you need to lose it all. If it goes to 200, you say, fine, I'm tired of this. I'm taking my 200. Okay? So that's a lotto. A lotto is meant to be lost, but you don't need to necessarily completely lose it. So that's the key factor, okay? So LinkedIn, for example, what happens is, this is the way it works in the market, okay? So what happens is, as it gets towards earnings, the stock will most probably, this is a beautiful chart, period. Overbought, no overbought, I don't care. It's a good looking chart. This is breakout. See these candles like this? These are breakouts. So don't mess around with these type of candles. There were two major candles like this, two generals. These are known as marching generals. Don't ask me who made that term up. I think it's kind of stupid. Oh, sorry, marching soldiers, because generals don't march. They sit in bunkers guiding the infantry, right? So I better be correct on this one. So the bottom line is, that's from my Marine days. Yeah, right. Just kidding. So here we go. So you get probably another candle. So you hit 220 real fast. Maximum move into earnings is 233. So right there, you have the 23 points, all right? So let's say right before earnings is 233. So what do? You go out there and buy more? No. You sell out your calls. You take a little bit of the profits that you made, and it's pretty significant profits from this level. You take that and you say, okay, I'm going to throw it in there as a lotto. Because by that time, the premiums are all stuffed. In other words, the implied volatility, or IV, okay, is high, very high. And you know how you know implied volatility? I don't know what platforms people are using, but on Thinkorswim, right before earnings, they actually tell you a range that the stock will trade in based on what the market makers are saying. Do you understand what I'm saying? So when I'm saying plus minus 36 points, I'm not making that up. Yes, my charts are showing that, but I'm also picking that up from Thinkorswim. That's called implied volatility, or what the volatility will be for the stock move post earnings. All right, so just keep that in mind. So saying all that, that's what you want to do. Now, once at this level here, the stock could very well go straight to 275. Mark my words, I've seen it happen. I've been there. This is a powerful company. And what I like about it, it is still on the lower end of the range. Let me show you some technical analysis, clueless style. This is a Fibonacci retracement. Anyone can do that. All right. So right now it is at over the 50. See that? This is a 50 Fibonacci retracement. It held the 50 overall this year. It slipped to the 38.2. Notice how accurate these things are, give or take a few dollars. And now it's over the 50. So right now, what is this? What is this? This is the weekly. Wow. Let me go daily. Now, actually, let me look at the weekly. So the weekly 50 and the 34 is right here. See that? So the weekly 50 and the 34 week simple moving average, SMA, is right here. So that's 221. So the stock has 11 points in it. Pattern completion is this. Please be ready. Might pull back a little bit before that and go up here. One way or other, LinkedIn, unless they really screw up, and I have no idea if they will or not, is going to 280. Now, whether or not it breaks out on earnings and goes to 280, or whether it pulls back first to about 210 before it goes to 280, I don't know. Guess what, ladies and gentlemen? The last thing I'll tell you, this could very well happen right after earnings. Earnings comes out, what happens? Stock pulls back 20 points. Assuming it gets here. Let's say it gets to 236. Okay, let's say it goes to 236. This could be the post-earnings play on recorded webinar here. So let's say it's not going to stay here. Let's say it gets here by earnings. I think it's next week, or is it after that? I don't have that direct in front of me. Let's say assume we get, when is it?
Next week.
There you go. So let's say it gets here by next week. So right after earnings comes out, it could very well do this. In after hours, I'm talking about. And then it opens up, or it might even slip more, because this is a high beta, high momentum stock. And then it goes like this, hard. Or if things are really bad in LinkedIn land, okay, and it got unlinked, then we are looking at the stock at 160, which is the floor for the stock. Now, is it possible that the machines and some hedge funds want to bring it down to 160 and then buy the crap out of it as the rest of the world is crying? So this would be the most amazing buying opportunity. And from a bullish perspective, this would be very bullish for me. I would buy the crap out of LinkedIn at 160. However, if it doesn't, then the next move up on the stock is literally a 30-point mover up here. Everyone understand? And at that point, pattern completion is completed. Does that mean it's going to drop really hard? No, it simply means it's going to move sideways. It's going to create a consolidation channel and then move from here. So that all remains to be seen. This is a weekly, so I'm looking at a very large picture. Looking at it on a hourly, it's on a complete tear up. Anybody who's trying to short this stock is an idiot right now, honestly. Wow, look at these. These are very powerful patterns. So you want to know how I draw, I mean, you guys know how I draw the lines, but let's say you want to do it yourself. Let me show you. What you do, my fellow traders, you do this. So on a very short-term basis, i.e. in the next 24 hours, do you think that LinkedIn can go up another 4 points? Yeah, absolutely it can go up another 4 points. Here, there is your channel. So this is the channel it's following. So personally speaking, as long as it holds 206, I'm okay. If it breaks 206, I don't like shorting stocks like this. Just so you notice, I don't short these stocks. You know why? Because they're monsters. So I'm shorting something in a bad market, let's say. What is the guarantee that it's going to really go down? How many times have we seen stocks on a bad market go the other way and go up $7? So I don't like shorting stocks. I like to make money on the short side through indices and other instruments. So primarily the S&P puts, the RUTs, the QQQs, things like that. So anyway, so that's it. So this short-term channel is 215 and 206, 7 points. Daily. One second, sorry. So daily, I am looking at, and we're going to wrap up right here. Remove drawing. So here, let's say we don't want to go to 276. Let's say that's too far. That's asking for too much. So if that's the case, you know what the lines are, right? Drawing, price level. There's a gap. Here's your gap. See that? So let me get the gap. Well, let me show you guys the gap, and then we'll wrap it up. So this is one of my favorite, one of the favorite earnings plays coming up, and even before earnings. Ladies and gentlemen, this is the gap. There. Okay. So this gap, the lower end of the gap, we are above it. No, we are actually right there right now. See that? Look on the right-hand side. What's the price? 209.57. What is the upper end of the gap? Can somebody say what's the upper end of the gap?
250.
Thank you. I believe after earnings, LinkedIn's going to 250. It's going to touch the upper end of the gap. Also, there is a gap here. Watch. Small, minor gap, major gap, right? Minor gap, top of the gap fill is what? 226 right here, right? Roughly. So before earnings, you have roughly about 15 points left in this stock. So if you have calls and stuff that you bought with me on Friday, and I bought my first position, so not my whole position. So I will be a active seller of this on the upper gap right here. See that? At 226. All right, so that's clear. And then of course you monitor it. If this stock breaks below 194, all bets are off. At that point, I don't like LinkedIn. All right, just so you know that. So you have to keep that in mind. That means these lines are going to flatten and go down. In the meantime, upper gap, short term, 24 to 48 hours, 227. Earnings, upper gap, 250. I'll take 250. Now, I mostly take it through common. And if I buy it, like I did with Amazon and stuff, I'll pay up to buy very few. And it doesn't matter if it's one. Okay? Deep in the money calls. Now, what is deep in the money calls? Let's say the stock is at 220. What is deep in the money calls? 195 to 200. Pay up for it. By at least if the stock does pull back, you're not going to lose all your money. If you buy way out of the money, if the stock doesn't go to 250, you lose that whole thing. Of course, you'll be paying a lot cheaper on the out of the money strikes, right? Or if you play stock, that's the scenario. Okay, now I'm ready to answer maybe one or two quick questions before I wrap up. Wow, it's 10 o'clock. That was a good one. Go ahead. Everyone's good?
I'm good.
Okay. Anyone have? Okay. If anyone, like I said, we covered quite a bit. So just to recap, what we covered today, very important. We covered the behavioral aspect of the markets. We covered macroeconomic global finance, what the realities of the markets are behind the scenes. We have, one other quick thing. The Japanese policymakers, the government is basically going to be talking about their policy. But I said that, in my opinion, is not that important, to be honest with you. Okay, China is far more important than Japan in the regional factor, in the global factor. So, and then we talked about market technicals, what we can expect, and then of course we talked about some specific instances on this on LinkedIn and earnings and how we're going to play that. Fair enough?
Yes.
Okay.
Yes.
So guys, you guys are fantastic. Thank you for all the support. We're growing pretty fast, and the only thing I request is people who haven't left the feedback on these sessions, please go ahead and do that. As we get more and more new people coming in, that's their way of knowing what other people are thinking. And believe me, I won't censor it. You want to write something crappy like, hey, he needs to improve on that, I don't like his voice, say it. Okay? So the point is, just put it there so they can see the feedback. That's the only thing I ask. And the other thing that I ask, very importantly, is get a lot of your friends, colleagues, and stuff to come in. Remember, the last thing I'll tell you guys. And Remik, can you still hear us? Okay, this is the most important thing on life and in trading. I mean this, and I'm not bullshitting. My real strength and power is to keep all of you in the game at the worst possible moments in the market, not at the best possible game. And I've done that. I've been here for people through and through on days the market's down 600 points, down 1,000 points, telling people what to do, what I am doing. And through all that, we have nailed the market. So my real strength is not when things are all happy and good. Everyone's like, oh my God, congratulations. I don't need congratulations. I need you to congratulate yourself because you managed to hold true with my guidance and my suggestions and things like that during the most difficult times in the market. That is what the Clueless Day Trading Service is all about. Not about happiness and like, oh my God, I just nailed 3,000%. Well, good. You did that because you managed to go through the most difficult times and make the right strategic decisions. That's how big money is made. Big money is not made with this. In my book, trading is not gambling. Gambling, the house has the dice loaded. They don't know what the heck to do. I don't go to Vegas. Yeah, I go to Vegas. My brother-in-law's got a beautiful penthouse out there, and but I don't go gambling on the floors. What's the worth? I don't give a crap. Yeah, I spent $20 on the slot machines. All right. So the point is that to me, this is calculated, strategic trading, and that's what I try to show people. That what I do, my method is not foolproof. I take my lumps, but my winners are 30 times more than the hits that I take. So keep your confidence high. Don't treat this as gambling. This is a business. Manage your business the right way. And I repeat, my strength is to keep you guys in the game at the worst possible time, when it looks like everything is just over. Nothing. The more you see the charts, the more you understand structured volatility, you realize that this is not like a random thing. There is a method to the madness. And let's focus on the method, not the madness. Just remember that. All right. So thank you for listening. Thank you for all the new members, and do spread the word, and we'll see you guys tomorrow. Okay?
Thank you again.
Thank
Thanks,
you.
Frank.
Bye-bye. Absolutely. Bye-bye.
Bye.